All right. Good morning. Thanks so much for tuning into the trade setup. I'm Neeraj Shah. Excuse me. And excuse me for being late. We are 4 5 minutes late, but that's okay. I think the news flow is very important to monitor. Keep in mind the key news flow is that the Fed has hiked benchmark rates by 25 basis points and hinted at a pause. And the Fed speak suggests that the ongoing assessment of whether the rate hike will prove to be high enough to bring inflation back to Fed's 2% target. So the assessment on is ongoing. And Fed has also said that there won't be any cuts if the inflation rate remains too high. So the people who believe or say that we told you so about the pace of cuts will also have something for themselves. People who said that, oh, there'll be only as much rate hikes in 2023 will also have something for themselves. Let's see how Jeffrey Dennis looks at this. He's our go-to expert for anything related to the Fed, and he joins us this evening as well. Fed, or this morning for us, this evening for him. Jeffrey, good having you. Thanks for joining in.
Thanks very much.
Anything in the action or the language that surprised you?
Not really. I think, well, certainly not in the language. I was a bit surprised by the market reaction. I didn't think it would be as negative as it turned out to be. And I think probably that comes from the fact that although the Fed changed the language and therefore de facto seemed to hint about rates being at their peak and this being the last hike, obviously a number of things that Chair Powell said in the press conference, worried the markets. First of all, it's going to take time to bring inflation down. No decision on a pause has yet been taken. There are going to be no rate cuts in the immediate future. Now, I haven't thought for a long time, in fact, at all, that there would be rate cuts later this year. So I'm not surprised by that. And I think also the markets are probably disappointed that there doesn't seem to be much policy reaction or policy thinking, at least on the surface, referring to the ongoing regional banking crisis in the US. So I think with that happening and some softening in the real data and with inflation clearly coming down, I think the markets probably wanted a clearer signal that we were at the peak. Now, I don't think this is all bad news, and I'm very pleased to see Asian markets rallying here today. And EM in emerging market, the emerging market index is up nicely tonight. So I think probably the US market overreacted, frankly.
Nikkei, Shanghai, and a few other markets are certainly in the green currently. So it's a bit of a mixed scene out there, but a lot of positives in the Asian screen in the session today, which is what Jeffrey Dennis is referring to. Now, Jeffrey, the question is, what forces the Fed's hand either direction? I'm guessing it's difficult to predict the oncoming data as to how it will shape up. Maybe you have a view there. But part two is also this whole regional banking issues that are cropping up, and we've seen one more bank in Beverly Hills this time around also teetering on the brink of collapse. How does that impact the Fed's thinking, if you will?
Well, let's talk about the regional banking crisis first, because I think the market was beginning to think the crisis was probably over with the earlier problems of Silicon Valley Bank and also Signature Bank. But now with First Republic also needing to be taken over, worries that is just going to roll on for a while. And I think that is something we have to keep an eye on. The depositors are getting very savvy about moving their deposits around, both to seek higher interest rates in this new higher interest rate environment, but also to seek safety. And so I think there could be no guarantee that we're not going to see further banks that come under pressure. And given that, I think the Fed is going to watch that very carefully. And that would, if this thing got significantly more serious, that would, I think, force the Fed's hand. Now, in terms of the economic data, I mean, the Fed says it's data dependent. Well, the Fed's always data dependent. I think it's kind of a silly term. They're always data dependent. There are going to be two employment reports before the next FOMC, and I believe there is now some strong signs that the economy is starting to slow, even if the labor market remains reasonably robust and the consumer. And by the same token, inflation is falling. My numbers suggest that inflation could easily be down to between 3 and 3.5% by the middle of the year, by which time, therefore, real interest rates are going to be over 1.5%. And that, I think, would give you a really good signal for the Fed to start to pause. Now, core inflation is going to be a bit higher, and of course, that's a concern. So I would be watching in terms of the real data, what happens in the labor market, what happens to the overall economy, but in particular, what happens, I think, to headline and core inflation. And those are the drivers. And I think the fact that the bond yields are lower tonight, and also the dollar is lower, is sort of telling you that investors believe there's going to be enough softness in the macro data and in the inflation rate to push the Fed to stop here. Although, as I've said earlier, I do not expect there to be a rate cut in 2023. I think that's a 2024 story. But that's, I think, what the Fed is going to be watching. It's going to be the banking situation and the economy and the inflation rate, of course.
Okay, so you preempted my question. I was going to ask you if you believe 2023 or 24. You've clearly said 2024. One very quick view, a view on risk assets, both US markets as well as maybe India as well, individually, or EMs in general.
Well, EM's been disappointing again, unfortunately. EM right now, although we're having a nice rally today, which I think is great, which is buy on the news, frankly, it does look like rates are now at the peak. I think the Fed is not going to raise rates again in this cycle. So that's going to be seen as good news. Now, it's still been disappointing. EM's up about 2% this year. Developed markets are up about 7.5%. So that's really been a disappointing performance. When markets rally, EM typically outperforms. The dollar's going down, although I think it goes down possibly a lot more. And I think what's going on here, I think it's been a second look at China, which of course is such a big part of the EM index, and I think that's been disappointing, and that's been a drag on the index. And some other big markets have not looked very good either. South Africa's been a good example. Latin America is doing quite well, although Brazil is weak. So there are a number of big markets that have pulled the index down. But I genuinely believe that any of these sell-offs we're getting here are a really big buying opportunity for equities, because I think rates are at their peak. If you ask me the question, I think rates have now peaked at the short end. You've got support from a lower bond yield and from a lower dollar. You've got inflation that is falling, albeit the core rate is falling more slowly. I think we will avoid a recession in the US. And obviously valuations have come down somewhat. So I think this is a real buying opportunity, and I'm positive. And although I'm a bit disappointed with the market's performance generally over the last 2 to 3 weeks, I think this is a good buying opportunity, not least because, as I say, it looks to me like the Fed is pretty much done with this monetary tightening as of this meeting today.
Well, thanks for that assessment, Jeffrey. Lovely as always talking to you and getting your sense on what the implications of the Fed moves might be. Really appreciate it this time around as well.
Okay, thank you.
Thank you for being with us. That's Jeffrey Dennis. And well, you have the view. I think, we'd spoken to BOFA sometime earlier, and their regional or their global economists too predicted that the rate cuts, if any, are happening not in 2023, 2024, but will the markets be happy with an extended pause and elevated rates? Well, maybe. It'll all be very impressive or interesting to see how it shapes up. For now, like I think Jeffrey said, that Asian markets are mixed. Now, very quickly, what's the trade setup therefore for the day today? I think you've seen that independent of what the global markets are doing, the Indian markets are holding out well despite the skittishness. Foreign investors continue to be net buyer for the 5th day now. Bought equities worth 1338 crores. Financials, anybody? IT stocks, though, are unlikely to find favor post Cognizant guidance, as well as the US regional bank turmoil. Remember, the more the US regional banks are in a problem, the more the belief around specific Indian IT names, save for maybe a TCS, not looking great. Yesterday, IT was a drag, and I would reckon that continues to be the case today. Specific bottom-up stories, though, continue to see large bets from dealing rooms. We saw that happening in tires, we saw that happening in textiles, and I reckon we'll start seeing that happening in chemicals. In fact, in certain chemical names, like example, Deepak Nitrite yesterday was up the most in maybe 6 months, with volumes almost 2x the daily average for the last 10 days. We've seen some good results from Tata Chemicals today. It's not spec chem, but it's chemicals, and therefore we might start to see some bit of flavor out there coming in a big way too. It's a big day for results too. Adani Enterprises, the big one really, post first time the results interaction post the Hindenburg saga. Hero MotoCorp, very impressive set of numbers to watch out for. Interesting set of numbers to watch out for, considering that their monthly sales numbers haven't been that great of late. Tata Power, TVS Motors, actually on the converse, has done really well. Seat, after MRF's big beat and the big rally in the tire stocks, needs to now prove that their numbers too can be strong. So I think a lot of very important numbers to watch out for in the session today. Sundaram Fasteners, Blue Star after Havells, all of these very, very important. Stocks to watch today. Very quickly, let me rattle through some. Titan, the first one on my radar. Revenues up 33%. Very strong performance. PAT up 40%. Very strong performance. No complaints out there on most things. EBITDA margin, though, what a bit to be desired. 10.5% versus 11.5%. And I think the con call, they gave away what happened. So the numbers seem okay. The con call takeaways, though, say this, that first half of April was slow. But May and June are expected to be good due to the wedding season. Apparently, more number of dates for a wedding. There's an expectation. The proof is that the first half was slow. The proof is that margins will be low because they're saying that the low cost diamond inventory benefit is absent in FY24 over FY23. So you would very likely not see too much of an improvement on the EBITDA margin numbers that they've clocked in quarter four, which is around 10.5. The estimates were 11.5, remember. So I would suspect that there are more minuses than pluses in Titan, a stock which is also fairly expensive. So bear that in mind. Brokerages are mixed, really. Morgan Stanley, as always, is bullish. Jefferies is a bit circumspect, so keep that in mind. Then Tata Chemicals, strong set of numbers, really couldn't find a fault. Revenues up 26% ahead of Bloomberg estimates, or you could argue in line on that base. But EBITDA margin 22.7%, 21.9%. Again, you could argue on that base, largely in line with estimates. But the profit number much higher than what the Bloomberg estimates were. 53.56 versus 711 crores versus estimates of 487 crores. Again, I was trying to figure out why is it that Bloomberg estimated the profit to be so low based on their estimates around margins and revenues. But be that as it may, it's a beat from Tata Chemicals, so to say, on the revenues and the bottom line, not so much on the margins. ABB India, you couldn't find a fault. Almost on all counts, there's a bit of a beat, but Nomura has a fault there. So first, the revenues. The numbers first. 22% growth in revenue ahead of estimates. EBITDA 285 crores, well ahead of estimates. EBITDA margin 11.8% versus estimated of 9.65%, well and truly ahead of estimates. And net profit though fell because of a corresponding quarters one-off. Q4 FY22 had a bit of a one-off. So the net profit number looks low, but relative to estimates, much higher. The point is, Nomura, and rightly so, you could argue that there is merit in this argument that the stock is expensive. They are neutral with the target price of 3274 because they value ABB at about 60 times calendar year 25 EPS of 54. Now, at 60 times Q1 CY25, CY25 Q1 is not cheap at all. But they see continued strong momentum in order inflows as a key upside risk. The EBITDA margin underperformance is a key downside risk. The key, as Nomura says, they prefer Larsen and Toubro within the India industrial space. Now, I must tell you, viewers, you will hear a number of times this commentary around how L&T starting valuations are so cheap relative to an ABB, relative to maybe a Cummins, relative to maybe a Siemens. But where I find fault with that argument is that if you look at the last 10-year average multiples, L&T would largely be at these. ABB largely is at 60, 65 times. So it's not that somehow ABB has become more expensive than L&T and therefore L&T will play catch up. That differential has largely always been there. So therefore, I don't know, I don't somehow find favor in this argument. But are the starting valuations expensive? Yes, they are. And therefore, is L&T from a valuation perspective a better stock? Most certainly is. Does that mean that I think ABB will not perform today? Well, based on what I speak with experts, I believe ABB could have a bit of an up move, but I buy Nomura's argument quite completely that is merit in probably staying neutral as well because the valuations are expensive. Let's see. We have a very nice conversation with ABB lined up for Monday. I think you will want to tune in for that. Jeffries came out a note on Sona on the results, retain a buy with a target price of 600. Earlier target price was 575. Strong Q4, revenues, PAT, etc., all above Jeffries estimates. They say that the new order win for bundled differential system for class 4 electric CVs underlines Sona's rising product capability and customer traction. They expect a 31%, 40% revenue EPS CAGR over FY 23-26, with 45% of revenues coming in from electric vehicles by FY 26. Strong show, very likely could react. Bajaj Consumer, moderate numbers, but you could argue on most counts ahead of estimates and therefore could react a little bit. Morgan Stanley's note on Aavas Financiers is interesting. They are equal weight with the target price of 1900. But the key on that Aavas Financiers piece is that there is a managing director's resignation, which is likely to be a key overhang on the stock in the near term. Let's move plates. Let's move on to Aavas Financiers, please. So equal weight, target price 1900. They say MD's resignation is likely to be an overhang on the stock in the near term, and that's the big thing. Even if the numbers looked okay, and even if the PAT was an 8% beat, the MD's resignation is an overhang. The stock very likely will start off lower today. IT stocks have no much thing to cheer because, like I said, the regional banks in US continue to have an issue, and Cognizant, the numbers, not the best. So better than the analyst estimate Q1 EPS of 1.04, but revenue numbers are lower than analyst estimates, right? They see Q2 revenues at 4.83 to 4.88. The range is good, but the range is midway relative. The midway of the range is in line with the analyst consensus estimates. The problem is that the FY23 EPS of 4.11 to 4.34 is lower than the analyst consensus of 4.43. So not much to cheer here. Plus the regional banking issue, IT suspected to stay lower. Lastly, very quickly on a very long trade setup, some stocks in news. Central Bank, they've given the exposure to Go Air. Number seems large, 0.91% of advances, so therefore maybe not as much, but certainly an issue. SJVN backed an order of 1200 crores. GR Infra projects L1 for a UP highway project of 737 crores. So lots of stocks to monitor in the session today. I would dare say watch out for Aavas Financiers on the negative side, ABB maybe on the positive side, Sona Comstar certainly on the positive side, Titan maybe a bit of a mixed bag. So let's wait and watch. There are some queries around ethanol. Well, I reckon that the story continues, viewers. So in some sense, some of the ethanol stocks or the energy stocks, as they like to call Balram, might continue to find favor. They might have an off season currently, but I reckon that the story is very much intact. If you look at what India is trying to do, which is be energy independent, both on the INR trade with Russia on crude, as well as ethanol, substituting some of those imports as well. So I think the story continues. Remains to be seen which ones will benefit. For that, you'll have to do your own research. Maybe we'll talk about it some other time. For now, though, I'll have to call it a day here on Trade Setup. Thanks so much for tuning in, viewers.